This video is the second of two, looking at the balance of payments, the current account, and particularly about the foreign exchange market as it applies to New Zealand, and with a focus on level 3 NCEA macroeconomics. So what we're going to look at in this video in particular is the idea of an appreciation and depreciation of the exchange rate, and who really cares? I mean, why are we studying this stuff? But if you watch the news, as I said in the previous video, you'll often see the business people talking about what's happening with the exchange rate. So let's look at the reasons why. The first thing to get in your head is when the exchange rate goes up, when it increases, that is an appreciation. I remember it by thinking of an appreciation. And when the exchange rate goes down, it's a depreciation, D for down. So you need to make sure you get those terms around the right way. So just an example to start with, suppose interest rates were lower in New Zealand. If that happened, we would become a less attractive country to invest in. People were looking for the best returns on their money. So they will have two effects. There'll be fewer overseas investors wanting to put their money into New Zealand accounts, so the overall demand for New Zealand dollars will fall. At the same time, investors who've got their money already in New Zealand may look to put their money overseas to get those better returns. So they'll need to swap out their New Zealand dollars for other currencies, and the New Zealand supply of New Zealand dollars will increase. So this is what it will look like. So we've got supply increasing, demand falling. You'll see that the exchange rate in this case will fall from P to P1, and that's called a depreciation. Notice in this case the quantity hasn't changed. That's just because the size of the shifts are more or less equal. We don't really worry about the quantity involved in this particular market. What we are interested in is what happens to the exchange rate. The other thing to be careful with here is we're just talking about the generic exchange rate. Overall, we'd expect the exchange rate to fall against other major currencies, but it can be currency specific depending on what's happening in Australia or the US or other trading countries for us. So let's look at this in particular. So an appreciation occurs if the exchange rate goes up. So say from US 75 to US 80 cents. So suppose you want to sell your good in the United States and you want to get 100 New Zealand dollars for it. That's your price. The US dollar price is going to change when the exchange rate changes. So originally you might have been able to charge 75 US dollars. Now, just because the exchange rate's changed, you have to charge 80 US dollars to get the same amount of New Zealand money back. So that's going to put our prices up, and we're going to lose customers. So not good for the exporter. In reality though, a lot of New Zealand products are sold overseas at the world price, set in overseas dollars, and they can't be changed. So you can't put your prices up. So what does that mean? Well, suppose whatever you're selling overseas, you're selling for 42 US dollars. Because of the change in the exchange rate now, instead of getting 56 New Zealand dollars back, you're only going to get $52.50, which doesn't sound like a big change, but if you multiply that by thousands of units, it means a lot less income for our exporters. So an appreciation makes exporters worse off. They have to either increase their overseas prices, which will lose some demand, or they'll accept a lower income. Importers are better off. New Zealand dollars now buy more overseas currency, so they are basically cheaper. We should end up with cheaper imports. Right, so let's see how that goes. Pause this video now and quickly sketch yourself a graph of the effect an appreciation will have on aggregate demand and aggregate supply. Okay, let's see how you went. So there are two effects. First of all, we've got a decrease in aggregate demand because exports are falling, and possibly because of cheaper imports, imports will go up. So net exports will fall. That's part of aggregate demand. Aggregate demand will decrease. Most people get that one. What they sometimes miss is the increase in aggregate supply. So aggregate supply will increase because imported materials and imported equipment are now cheaper. So particularly oil and petrol will now be cheaper, so aggregate supply will actually increase. The effect on real GDP is likely to be a decrease. It's not good for economic growth. The shift in aggregate demand, because our export sector makes up 30% of our economy, that's going to have a big effect on our economy, bigger than the effect on firms' costs. So bad for economic growth. We've got real GDP falling. The price level will definitely fall because we've got cheaper imports and we've got less demand in the economy. So an appreciation will be disinflationary and will help with price stability. Not good for economic growth, good for keeping inflation under control. So a depreciation pretty much has the opposite effect in terms of importers and exporters. So if you're learning this for an exam, focus on an appreciation, say, and the opposite effect occurs for a depreciation. So exporters are better off if we have a depreciation. They can get more New Zealand dollars for the same overseas price. So they can leave their price the same overseas and they'll get more New Zealand dollars back, or they could actually drop their overseas price and still get the same amount of New Zealand dollars back. So export receipts will go up. Imports are worse off, importers are worse off. New Zealand dollars are worth less, so they'll now need more New Zealand money to buy the same goods they were buying before. So the price of imports will go up and sales of imports are likely to fall. So again, pause this video and have a go explain the impact of a depreciation on the economy using a circular flow model this time, and try and refer to the real and money flows. Okay, go. Right, so that's how you went. So first of all, there's the obvious. If there's a depreciation, exports will increase. That's a real flow because prices will be lower, can be lowered overseas, or because more New Zealand money comes back when our goods are sold overseas. Our products are more competitive. Imports, another real flow, will decrease because they become more expensive in New Zealand. So on the money side, export receipts will increase and import payments should decrease. There is a but there, as you can see. You've got to be a bit careful with import payments. It does depend on the price elasticity of demand. Things like oil and petrol, we're going to keep more or less keep buying even if the price goes up, because demand's inelastic. So in that case, import payments will actually rise. So we'd be a bit careful. But for the purpose of NCA, we will assume that the increase in exports will be decent and import payments will go down, so the current account will improve in this case. Then of course there's the flow-on effects. If New Zealand exporters have got higher incomes and the export receipts are going up, they may need more resources to increase production to meet the higher demand. So resources, the resource flow will increase to producers. That in turn will increase household incomes, especially because employment is rising, but not just wages of course, but also profits for those exporters. So there's a flow-on effect there. At the same time, businesses that produce import substitutes will be better off because if imports are more expensive, people want to buy more of their goods. So those firms will need more resources to raise production. They will be paying more income to households and so on. You could go on and on with those flow-on effects, but that's certainly the initial one. Of course, the government will also be receiving more tax in the form of company tax, assuming exporters are now more profitable. So you need to make sure you've got your head around the pros and cons of appreciations and depreciations and be able to show it both on the circular flow model and the aggregate demand and aggregate supply model. So one last thing, have a look at this graph. This is the US exchange rate against New Zealand, the New Zealand dollar over the last 3 months. As of today is mid-August in 2016. Don't worry about the numbers down the bottom. Have a look at this. What do you reckon? Is this is a good thing or a bad thing for the New Zealand economy, and why? I'll give you a few seconds to jot down some notes. Right, so the first thing is the New Zealand dollar appreciating or depreciating against the US dollar? You can see that the exchange rate's been more or less increasing, at a bit of a dip a little while ago, but basically it's been increasing, so we have an appreciation. So in general, that by itself means it's bad for the New Zealand economy in terms of the economic growth. Exports will become less competitive anywhere they're sold in US dollars, and so those exporters will get less income. Economic growth will fall. Aggregate demand will fall. However, at the same time, it is good for price stability because it means that imports from the US or valued in US dollars will be cheaper and that will keep our prices under control. So always remember it's got that double whammy effect when you're doing this analysis in terms of the effect on the overall exchange rate. All right, that's it for me. Good luck. Hope that all made sense for you.